Securities offered through Kestra Investment Services, LLC, Kestra IS, member FINRA SIPC. Investment advisory services offered through Kestra Advisory Services, LLC, Kestra AS, an affiliate of Kestra IS. Capital Advisory Group, Inc. is not affiliated with Kestra IS or Kestra AS. Neither Kestra IS nor Kestra AS provide legal or tax advice and are not certified public accounting firms.
You work hard for your money. For the next hour, you're going to learn how to keep what's yours. Capital Advisory Group presents Keep What's Yours. Here is Josh Gilbert and Jeff Zufall.
Hello and welcome to Keep What's Yours with Jeff Zufall. I'm Josh Gilbert, sitting here with Jeff Zufall, Senior Tax Strategist and Wealth Advisor with Capital Advisory Group. Hello, Jeff.
Hi, happy Saturday.
Jeff calling in on the phone today because, man, we are in the thick of it. And sometimes you just can't pull away from the office.
That's right. It's we're deep into tax season.
And then I think I texted you during the week and said, "Hey, you hanging in there? How you doing? Everything okay?" And you were just barely coming up for air. So how are we doing? Yes. How's everything looking? You caught up?
Yeah, so far so good. We had a big, remember we had talked about the President's Day rush, that's when everybody sits down and starts to put their stuff together, and the IRS says that's one of the busiest days for them for the phone. It's true. It's really true. Because right behind the President's Day holiday, everybody and their brother showed up with tax returns.
Yeah. Hey, ding dong, dropping it off right at
time.
The office there.
Yeah.
So the thing is that we are in the thick of it. And what can you do? We do a show all year long because taxes aren't just an April 15th thing. We want to make people aware that every time you get a paycheck, every time you win some money at the casino, Jeff, I've been wanting to talk to you about this. Everything that you do in your life, you sell a house, you sell a car, you sell some stock, everything you do in your life has something tax associated with it.
Exactly. It'll end up on a tax return at some point in time.
And whether you pay it up front and you have the receipts on the back end, everything needs to be logged because with these 1099s that everybody's talking about, they're going to push off the whole 1099 revolution, which was supposed to take place this year, but they're going to push it off another year because, frankly, the IRS said, we can't handle it. We're not ready yet.
They were not ready.
But if you sell something for, what is it, over $600, or if you make some sort of a $600 transaction, there's a 1099.
It used to be that any transaction, just basically if you were like a subcontractor to someone and it was $400 or $600, you're obligated to kick a 1099 off. But if you are self-employed and you made, $100, you're supposed to be on your honor. You're supposed to report it on your tax return. No different than when we talked about finding the $20 on the street. Technically, that's found money. It should
on your
be
honor.
Reported on a tax return. Yeah.
Yeah. And that's one of those things. It's like you find $20 on the ground and you put it in your pocket. You don't think anything about it. Well, the government technically says that you need to submit that as income for your tax returns. So that's kind of weird, kind of goofy. And if you sell a lot of stuff on eBay, you in the past maybe have just kind of taken it in your PayPal and put it in your bank account. Never thought about it again. But in the future, not this year, but in the future, the government is going to be aware of that. And a 1099 is going to be, very aware. Exactly. 1099 is going to be kicked off. And whether you like it or not, that's going to be on your tax return. So you need to keep really good notes going forward. And Jeff, if you've got clients that do a lot of, I know my sister-in-law sells a lot of stuff online. If you've got clients that do a lot of that stuff, there's a reckoning coming. Whether they like it or not.
Yeah, because it used to be $20,000 of revenue or 200 transactions, and then anything above those limits would kick off those 1099Ks. But for 2023, it's still the same, but 24 is where they're going to change it. dramatically, and pretty much every nickel that runs through there is going to be subject to some type of a 1099-K. Which the average person, if you send money to your kids in college, you Venmo them money, it's easier way to get it to their bank accounts, so on. That's going to show up as a 1099-K, and there's no way to make it go away, basically, other than report it on a tax return. And there's a couple of different angles you could take on a tax return to offset it, so you don't end up paying tax on it. But it's just the hassle of getting those and/or filing your return and forgetting about them. And then you get a nice little letter from the IRS about 14 months later that says, hey, you underreported your income. And they're very aggressive letters from the IRS in the states. And you have to contend with that to make it, to fix it and make it go away.
Yeah. And I hate to say it. I hate to think of it like this, but the government is hiring all those new IRS agents to help keep track of this. And
yes.
To be completely honest, Jeff, that's the way the law has been. We've just been pretty loosey-goosey with it. So now they're saying, look, this is the law. We haven't really been enforcing it because we haven't had the man and woman power to do it, but now we do. And so we're going to look at it. So the question is, how do we stay on the right side of the law? We've probably been, following the law, and we can follow the law to the letter, but it's just going to be harder now.
Just, more compliance, more regulations are in the mix. We do have a new sheriff in town, too. He was just approved by Biden. I guess that was Thursday. So a guy named basically Danny Werfel will be the head guy of the IRS. So he won the Senate confirmation. So he's going to run this $20 billion or the $80 billion expansion. In the past, he was an acting former IRS commissioner. Which is pretty funny because in 2013, I believe it's 2013, he actually ran the IRS. And then he backed off and he went to work for some Boston consulting group. And now he's coming back as the commissioner of the IRS. So, he has some knowledge of how it works. So he's not new to the territory in a sense. He did get bipartisan agreement, on both sides of the aisle. Love him, apparently. But the funny part is he is going to help he's going to help spend this $80 billion that they're getting. And they were supposed to have, the IRS was supposed to have a plan. We talked about this a couple of weeks ago, a plan on how they're going to spend their budget, on how they're going to spend this $80 billion. They were supposed to have it to Janet Yellen by the second week of February, and they didn't show up at their meeting.
Oh, great.
So they were not ready with their budget meeting. So he's going to help write this and finish this document that's supposed to be then proposed back to Janet Yellen on how they're going to spend it, and now they're giving them until August to actually put this together. So, and it's supposed to include, all the little benchmarks, for how they're going to measure their performance and so on and so forth as you go forward. So we'll see.
And it's just one of those things, we say it all the time, that the IRS is not out to get you and me. They're not. They don't know Josh Gilbert. They don't know Jeff Zufall. They know us as Social Security numbers. Yeah, and
exactly.
Most of the time this stuff runs through a computer, and if it's all on the up and up, nobody says a word about it, and we get our tax returns and we go about our lives. But if it gets hung up, if it gets caught up, if numbers don't match up, if you're e-filing and you forget, a 1099 that like we always say, the IRS has a number in their hand and they want to say, well, what did you come up with?
What do you think? Yeah,
what
exactly.
Do you think?
What do you think?
And if they match up, perfect. If they don't, well, then you might get a letter. But we just need to be aware that we have to stay within the guardrails. That's what you say all the time, Jeff.
Yeah, seriously. Got to stay within the guardrails. The IRS will leave you alone as long as you're within those confines. There's always gray area in tax law, but that's when you push it to the extreme. Other than that, it's pretty simple. Hey, you could take this deduction and you can't take that deduction. And here's the times you can and here's the times you can't. So that's what you're actually up against as you go forward. If you start taking crazy deductions like, I'm going to claim my dog as a dependent, that could be an issue.
Yeah, my cat is an employee.
Yeah.
But you're talking to a real tax professional and a guy who's been there, done that, and seen it all when he says, it's pretty simple.
It is.
Jeff just said it's pretty simple. Well, not to me. And not to most of the people listening right now. But let me give out the phone number. If you want Jeff to do your taxes this year, if you want Jeff, and what's done is done. And now we're just making a recording of what happened in 2022. And we've got to, like we say, match the numbers up and make sure that we're in the good graces of the IRS and make sure that you pay something come April 15th. We'll get into that in the next segment. But if you want Jeff to do your taxes, and more importantly, if you want Jeff to look at your stuff and make sure that come next year, when we submit our 2023 taxes, that we found we're keeping more in our pocket than is going out to the IRS, that's what you get Jeff on board for. 636-394-5524. We do the flex at the FSA, the flex spending account for our son's daycare, and we get to keep at least $1,200. We'll see if I'm coming in, Jeff. Next week. We're coming in at 7 o'clock at night. You're going to clear some space for us, move some papers around so we can sit down.
That's right. Move those giant stacks.
Yeah. And we'll find out how much we got to keep this year. But if you're not doing anything, well, you're probably paying the government more than what you have to. Exactly. So the idea is to keep a little bit more of your money in your pocket, on your paycheck, in your savings accounts, than going out to the government. And there's a legal fine way of doing that. And the IRS actually has some benefits that we can take advantage of, but they're not coming out to our houses and telling us that. We have to find someone like Jeff to set us up. So the number is 636-394-5524. Capital Advisory Group, CapitalAdvisoryGrp.com is the website. Jeff, let's go to commercial break, but when we come back, we'll get into this year. And the time and time again, we tell people, you have to pay something. You have to submit something. Don't bury your head in the sand. You can get an extension. It's pretty easy, but you have to submit something. We'll talk all about your tax returns and put something in, and don't just ignore it as we come up to that fateful deadline. It is Keep What's Yours with Jeff Zufall on the Big 550 KTRS.
Keep What's Yours continues with Josh Gilbert and Jeff Zufall.
Back in the Big 550, back to Keep What's Yours with Jeff Zufall. We're talking to Jeff. He is the Senior Tax Strategist and Wealth Advisor with Capital Advisory Group. And tax day this year is on April 18th. Jeff, that is a Tuesday. That's kind of weird.
Yeah. Well, the 15th falls on a Saturday, so you don't have to file. And then Monday, the 17th, is Emancipation Day in Washington, D.C., so since they have a holiday, the rest of the country gets the holiday too. And so the final day to file either your return and/or an extension is April 18th of this year.
And we always talk about this. Yes, we are not just an April 15th, or in this case, April 18th tax show. We are a year-round tax show to tell you that there are things that you can do every paycheck. Make sure that you're getting enough withholding. Make sure you're putting enough into your 401k and doing a Roth, or maybe like what we're doing with a flex spending account or a health savings account. If you've got a lot of medical bills, these are things that you should be doing year round. But this time of year, we're definitely an April 15th kind of tax show. So what do we need to know about extensions? And we always say, even if you don't plan on filing a full tax return, you want to get an extension, you have to pay something.
Yes. So an extension is literally just a 6-month extension to file the paperwork. So everybody's like, just get me an extension. I'll worry about it later. It works that way, but it doesn't. The IRS still says, hey, you owed us money. Now, if you got a refund, that's okay. They'll pay you interest from April 18th to whenever you file your return if they owe you. But if you owe them, they will actually get you for failure to file, and you will owe them interest and penalties rolling forward until the day that you pay your taxes. So anybody that's a small business, just don't file an extension to file an extension. You can file an extension, but actually take a good guess on what you owe. Typically, it's your previous year's tax liability. If everything is the norm in a sense going forward and you just haven't got to, putting together your numbers, go look at your tax return last year, look at what your total tax was, add up if there's any W-2s in the family, if your spouse works or whatever, what was paid in federal and state tax, and then pay whatever that difference is to get you to what your previous year's tax liability is. And if you've made estimated payments throughout the year, you should include those also. But if you owe, or you even think you owe them more than $1,000 on the federal and on the state side, go ahead and pay some money. Pay $1,500 to cover it. Again, if you overpay when you do your return and it turns out that you had more expenses that you thought that from the previous year, you'll get that money back, or it can be applied to 2023's estimated payments as you go forward. So it's a matter of not just filing a return to say, hey, and we used to I won't say we were guilty of it, but in the past, you'd say time value of money, hey, that interest that you're going to pay them to use that money for the next month or 2 months or 3 months, used to be a cheap rate when interest rates were, next to nothing. Today it's not. So the quarterly rate, I believe, is like $4.75. So that's what they'll actually charge you for money that's owed. So, again, at the end of the day, pay something, make sure that you've at least got it within $1,000 on the federal side and on the state side.
Yeah. And Jeff, let's rewind back to when I was, 25 years old. And, I didn't make a lot of money, but I also wasn't really too worried about the government coming and hounding me and everything. And then I just, I'll get around to it when I get around to it. And if I pay him, I pay him. If I don't, I don't. What's the worst that could happen? Well, burying your head in the sand is the worst thing you could possibly do. Not only will you still owe them that money, but now you're going to owe them penalties. You're going to owe them interest. They're going to come after you. You're, going to have to look over your shoulder to see if the IRS is sneaking up on you.
And even if you say, I just can't afford to pay them, file the return. Come back and do an installment agreement or some type of a payment plan with them. And again, as long as it's not a ton of money, over $50,000, it's probably, I'd say 30,000-ish tops. In the past, what they would do, now again, COVID kind of messed everything up for them. But in the past, if you owed them, owed them more than $30,000, they would just drop a lien on you, no questions asked. But file the return, because they also have on the flip side of that failure to file, which means to actually physically file your return. They'll charge you a fee for that or a penalty for it. And then if you owe them money, then they'll charge you another fee on top of that, which is failure to pay. And then on top of that, they will charge you interest on a rolling quarterly basis going forward. So it gets really expensive really fast. So worst case scenario is go ahead and file the return. But if you can't afford to pay it, then turn right around and ask for an installment agreement or a payment plan, and at least get something going, versus blowing it off and 5 years later that $30,000 tax bill is a $450,000 tax bill. That wakes you up.
Right. Well, I mean, isn't that the thing? If you can't afford to pay the taxes, then, why are you asking them, hey, why don't you just slap some fees and interest right on top of that? You know? The best thing to do, the most responsible thing to do is to address it. And the IRS will work with you, and for the most part.
And they will.
Yeah. We're not all owing $30,000. So,
exactly.
There's room to wiggle there. Just do it in the legal, responsible way. And you can set up a payment plan, and Jeff can help you get that rolling. 636-394-5524 is the phone number to call. Capital Advisory Group, Jeff Zufall, until the government finds out a way to send us a postcard and say, this is what you owe us. Here's a check. It's already filled out. You just have to sign it. There's going to be need for people like Jeff. So
yes, most definitely. And the postcard probably will never happen at the rate we're going. With some of the stuff that's been tossed out there in Biden's new tax plan, he's hitting probably 6 or 7 different sectors of the market, but the tax side of it's going to get even more complex, I believe. So postcards are probably long gone.
It's a great idea, but the powers that be in Washington D.C. There's too many lobbyists and too many people at the big accounting firms that are pushing
for all these weird deductions and credits, and if you do this, you get that, and so on and so forth. So it does get complex at the end of the day.
Yeah, and until they simplify it, Jeff, you'll be in business. And as long as and I bet Jeff, I bet deep in your heart, it would probably be much easier if they did it that way. But until then,
it'd be a lot easier. Believe me, there's some headaches that we look at and we're like, wait, we got to research that. Just because the laws change so many different times, you don't know what side of the table you should be on. And you go back and read, and that's the other side of the equation, is some of these laws, the way that they're written, if you actually read the true tax law, you'll scratch your head and read a paragraph and go, I don't even know what they just said. They just talked in a circle. So then we rely upon other firms, some of their written documentation, kind of I'll say the accounting community in general, to say, here's what our 5 cents is on this, and everybody kind of starts to follow a path, and we go from there. So kind of gets crazy. So
yeah, and it's just tough to kind of wrap your head around the fact that they're making it as complicated as possible.
Yes.
But as long as there's a Jeff Zufall out there, we can do this, and it's probably worth more in my time than it is in my money to just have someone else do it for me. I can take off and enjoy the weekends as weekends, and not as my wife said the other day. Yeah, my wife says, we've got that meeting with Jeff coming up. I just need a couple hours to get all this stuff together. And I'm like, honey, isn't that what Jeff's for? So
let her put it together. It's okay.
I think what we're going to find is that she's going to get some paperwork together and find out that getting the paperwork together actually didn't take as long as she thought. And then when we give it to you, you'll probably go through it a lot quicker than we could anyway. So you're saving time. And if Jeff looks at your taxes and figures out some avenues that you can go down where you can keep a little bit more of what's yours, you're probably going to be saving money too. So the number again is 636-394-5524. So tax day is on the 18th of April this year. Submit something, pay something, get Jeff on your side and find out what he recommends that you do. You have to do something though, or else the fees and the interest will start cooking. I love how they have failure to file and failure to pay are 2 different fees.
Yes, yeah. 2 different fees. And they'll hit you for both of them at the same time, plus a couple others.
So don't just bury your head in the sand. If you're having some issues this year, you have to do something about it. Average refund this year is down 11%. Why is that?
Yes. So the statistics that they've just put out, and this is from February 18th of this year going back to February 18th of last year, and they're pulling these numbers together, which basically it's down 11.2%. So the average refund for 2021 tax year was $3,536, and the average refund so far for 2022 is $3,140. So it's 11.2% decrease on the average, and that is really allocated or set up the less stimulus money that's out there, than the child tax credit, and the ability to do, and we've had it for, I guess it was 20 and 21, we had a $300, if you were single, you got a $300 non-itemization deduction for charitable contributions. And then if you were married filing jointly, you got a $600 non-itemization, which means you don't have to itemize. You just say, hey, I got $600 worth of charitable stuff, and you take a $600 deduction. Those are all wiped away for 2022's tax scenario. So the problem is you have people that the only way to get a charitable contribution today is to itemize, which takes a chunk of money. And the child tax credit went from, I think the max was $3,600 back down to its normal of $2,000. So there's a $1,600 difference right there, straight across the board. Then there's some other little tidbit stuff that was never really voted back in the tax law for 2022. So, and the odds on getting some of these things back are very, I'll say, limited because of the political landscape today. A lot of this stuff just won't be voted back in or won't be voted on until 2024, which is presidential election. So whoever wins, that'll kind of tell us what way we'll go with some of the tax law stuff.
Yeah, and we've seen this in action with this is the reason why the whole country knows the name Joe Manchin, senator from West Virginia, is because they wanted to put that child tax credit. It was kind of boosted. I was getting checks from the government every month, and everyone with kids were getting it every month. And they wanted to continue that. And Joe Manchin, he was a Democrat, said, not interested. I don't want it. Let's just take it back down to what it used to be pre-COVID. And that's kind of where we ended. It was a stalemate, and he won.
Yeah, and he had the power. He won. So basically it was not voted back in. Now that's part of Biden's new plan that he's thrown out there. I think he just threw that out there the other day. His new, proposed tax payments and so on and so forth. Child tax credit comes back into play in 2024. But again, we have a presidential election, and, so who knows what really gets voted in and what doesn't. So,
yeah. And so just be on the lookout and just know that for the past couple of years, you've been getting more of a boost in your taxes because the government wanted to make sure that we were comfortable while we were trying to make it through the pandemic. But now that we've seen that most of the worst of the pandemic is over, they've kind of scaled that back a bit. So if you're looking at your tax return from last year, don't expect to be getting the same kind of numbers this year.
Yeah, it's not, and we even see it, that's the norms, if you want to call it, on average that the IRS is giving. We're seeing it for the average person getting, a couple $100 less than what they did in the past, but everything stayed the same. Their income was the same. Their withholdings were the same. No change of children as dependents, but it's a couple $100 less than what it was the year before.
Yeah. So I'm going to remind my wife that, Jeff, because she's very much, why is this? What is that?
Yeah,
it's like,
exactly.
It's just different this year. And unless you keep up with, the legislation and the tax laws and all this stuff, you just don't know it. And why would we keep up with this stuff, Jeff? This is boring stuff.
It is. Some of it is very dry when you read it. And I guess maybe you got to have a warped sense of humor. I'm not sure, but
yeah. But I like to remind everyone: do you pay taxes? Do I pay taxes? Jeff, do you pay taxes?
Yes.
The answer is yes. Yeah. And so this really does apply to all of us. So it should be, this should be the number one show across the country, Jeff, because it pertains to everyone. We used to do the pet show, and not everyone has a pet, but everyone pays taxes. Yes. So let's go to a commercial break. And when we come back, we'll see if Jeff can explain what the standard deduction is, because that is coming into play as well as we go to finalize our taxes for this year, paying for 2022 and getting prepared for 2023. We've got, 9 months left. Well, that's 9 months of keepings of money that I could keep in my bank account and away from the federal government, and Jeff can get us set up for that. It is Keep What's Yours with Jeff Zufall, Senior Tax Strategist and Wealth Advisor with Capital Advisory Group. 636-394-5524 is the phone number. Have you done your taxes yet? Have you submitted them? Have you paid? Have you set up a payment plan if you weren't able to pay for your whole taxes, your tax bill this year? Jeff can help you out with all of it. And this is the bigger note. He can prepare you for next year so that you don't have as big of a tax bill as you did this year. That's the goal, Jeff, every year, is to make that tax bill a little bit smaller. And by that, we get to keep more of our money. How about that? 636-394-5524. We'll go to commercial break, and when we come back, standard deduction. We'll see if Jeff can explain it for us. For I'll put myself in this camp, for the dumber ones of us out there. Standard deduction. We'll be right back.
Keep What's Yours continues with Josh Gilbert and Jeff Zufall.
Back in the Big 550, back to Keep What's Yours with Jeff Zufall. And Jeff, I've got the website pulled up right now, CapitalAdvisoryGrp.com. Here's the phone number, by the way, 636-394-5524. We've been saying this for years, and it looks like the big guys who have enough money to pay for Super Bowl ads have finally jumped on it. There's the ad that's running right now where the dad is sleeping on the couch with his baby, and it says, do this instead of, you could be doing your taxes right now, but you got smart and you had someone do your taxes for you. So now you can sleep on the couch with your baby, which is what maybe I'll be doing this weekend. And then there's that one Super Bowl commercial, which is weird. I didn't really understand it, but some guy was dancing in front of a fountain, and it said, you could be doing your taxes right now, or you could be dancing in front of a fountain. Which would you rather be doing? The gist of it being, Jeff, is what we've been saying the whole time we've been doing the show. Why try to do your own taxes? It's complicated. Yeah. It takes you a lot longer than Jeff can whip it together. We are probably going to mess something up, because whether it's a math issue, which I'm not good at math, but, even with calculators, we just don't know how the tax system works. Yes. And then the most obvious part is, what could I be missing? What could I be paying taxes on that maybe I don't necessarily have to? Exactly. And when you think about it, if I'm sending money to the government and then I come back and find out, I didn't have to, I could have done a FSA, or I could have done an HSA, or I could have done this, I could have done that. I just sent, $1,200 to the government, and I could have kept that in my pocket. No, that's ridiculous. I'm calling Jeff today. 636-394-5524. It's not about just filing your taxes. It's also about taking a look at what you've got going on and making sure you're not giving the government more than what you have to. So
legally obligated to pay.
Exactly. And, I always say this, and I don't think it's true because they probably don't even have a bell in the building. But as soon as my tax return gets shipped over, they see it and they go, oh my gosh, someone's utilizing the tax code to their benefit. And it's not a Fortune 500 company. It's a person.
Exactly.
In Missouri who's using the tax code to their benefit. Ring the bell and everyone, we're going to go have drinks now because Josh Gilbert in St. Louis utilized the tax code. No, they probably don't even care or notice because I'm just a number on a page to them. But it matters to me. That $1,200 that we're saving on my son's school, that matters to me. That's going to help us go to Disney this summer. So
exactly.
Give Jeff a call, 636-394-5524, not only to do your taxes, but to make sure your tax bill is lower in the years going forward. There is a button on the website that I'm looking at right now. Where's my refund? You were saying that the backlog, when we started earlier in the year, the backlog was at 10 million. I think it was at 30 million at one point.
It was an insane number. I mean, they still have, they've made huge strides in getting this back under control. So we still say that paper is the kryptonite to the IRS, but there's a couple of circumstances like an amended return that you don't have any choice. You have to mail it in. But if you filed, and this is going back to the backlog that was sitting out there for the 2021 tax year, they're saying that they've caught up all the electronically sent in 2021 1040s, which are the individuals. Those are caught up, ready to go. And then there's only, and I say only, 206,000 paper returns still waiting to be reviewed or processed. And that's something where that had an error, say that they suspected fraud, they hold it up, or if it had a blatant math error, it sits on it. So, you're talking from, we were like 30 million, I think, was the original number. We're now down to 206,000. So that's huge strides getting that under control. But here's some advice. If you filed your 21 return, a paper return, and you're still waiting for your refund, you're like, hey, they never paid me. We hear that all the time. They never paid me. So first, what you want to do is go to that, where's my refund? You can go to our website, just like you were saying, click on the button. You need basically your Social Security number, your zip code, and your filing status for the year that's in question. And if you see nothing on there, where it just says no information, doesn't say a word, what you want to do, and it's been more than 6 months, you want to try to either e-file that return if possible, and if you can't, resubmit it. And if it's been less than 6 months, they want you to wait since you filed it. So the bulk of these will be over 6 months. Basically, what you really should do is reprint it, and in a red pen, put do not duplicate previously filed, and put that at the very top of the return so it's blatant, and then mail it back in. That way you don't get two refunds at a later date, and then you have to figure out how to get that refund back to them because it adds more fuel to the fire. So that's kind of where we sit today. So they're making strides. So that's good news.
Yeah. Going from 30 million to 206,000 is pretty good, but the government, as we talk all the time, that they're shooting for just to answer the phones. They're shooting for 80%.
Yes, so 85% is what they're shooting. They were at 13% last year, and their goal this year is 85%, which I don't know how you set that bar, but that's a pretty low bar to set. But at least it's progress.
You go to any business in the world and they say, well, we only answer 80% of our phone calls. That's business. That's lost revenue.
Exactly.
Mr. Dorsey would be furious if I only read 80% of my emails.
Exactly.
But that is what the government is shooting for, because as of right now, they're answering like 5% of the phone calls. They just don't have the people. Yeah.
Yeah, it was 13% is what they were on average answering. So they're going to try to raise that bar to 85, which is huge. I mean, if you really do the math on it. But again, at the end of the day, as a taxpayer, and as everybody listening as a taxpayer, you go, wait, that's not that high of a bar. So
yeah. Well, that's the best the government can do. So let's talk about the standard deduction. How do you explain this to people? That's where most of us fall, right?
Yeah, almost probably 90% of America is going to take the standard deduction. No questions asked. It's not worth adding anything up. And I say that unless you have heavy medical expenses or you have a huge tithe to the church, or to some charitable contribution. But what it is this, as we sit for our 2022 tax year, if you're single, you get $12,950 out of the box that you do not pay tax on. That's the easiest way to explain it. And if you're married filing jointly, you get $25,900 that just comes right off the top. And so you go, well, wow, how would I get over that hurdle in a sense to get to what's called a Schedule A, which is itemized deductions? So that is what you do is you're going to break out deductions for your mortgage interest, your charitable contribution, your state and local taxes, which, by the way, was capped at $10,000 max. So that's where you got one arm behind your back in a sense, because that's really what holds everybody back from being able to itemize. And then medical. So all that stuff is added together, and if you could break that barrier of either $12,950 or $25,900, then it opens up that door to itemize. But you need more stuff, so you'd need $27,000 worth of items to be able to really take advantage of being able to itemize. And in most cases, it's not worth trying to find, your charitable contributions, and you gave cash and non-cash, mortgage interest, and your state and local taxes. Basically, you get capped at 10. So really, most people aren't even messing with it anymore. Now, if they ever increase or take away what they call the SALT limitation, and goes back to prior 2019, you were able to take, not so much Midwest, but East Coast, West Coast, your state and local taxes, you were able to deduct it, which basically is mortgage interest, okay, real estate tax, that kind of stuff. But you're capped at $10,000 now. So now nobody can really even take it as a true deduction. So what takes place is if you're over 65, you actually get to go for 2022, you're $14,700. So it was $12,900 for single. If you're over 65, single, it's $14,700. So the bar is raised even higher. And if you're married filing jointly, it goes from $25,900 to $27,300 for 2022. And it goes, this is the funny part, is for 2023, just the standard single is $13,850, and married filing jointly is $27,700. So if you're over 65 next year, it goes to $15,700 and $29,500. So those are numbers that you'd have to give more than that away or pay more in state and local taxes. So the easiest way is just take standard deduction and not worry about it.
Yeah. So would it be fair to say that the only way to hit that itemized is if we, we're high income earners, we gave a lot of money away? Do medical bills count towards that?
Medical bills do, but there's another trick inside of that, which you're capped to the first 7.5% of your adjusted gross income is on you. And anything in excess of that, you get to start writing off. But that is basically medical premiums that you pay. So you get like if you're on Medicare, you get your Part B, that you pay a premium for, that's deductible. If you have long-term care insurance, that falls in that medical deduction side. So, and depending upon your age, you get a certain percent of what your premiums are. And then medical, doctors, dentists, prescriptions, but all that stuff is subject to 7.5% of your adjusted gross income. That's that's on you. So if you got $100,000 of income, $7,500 is what you have to pay out. Anything in excess, you get to start taking a small deduction for it.
So you'd almost have to have $30,000 in medical bills.
Oh yeah, before it really kicked in to where that would pop up high enough. and then maybe give to the church at the same time, with your state and local tax being at 10, between the combination of all those could get you there, but typically it doesn't. So most people it's not even worth adding it up just because you have to jump over this hurdle of, $29,000 or $25,000 to get there.
And I'm sure you could just eyeball it and say you're not even close, or, hey, this is close enough to let's add it up and see where we're at.
Exactly. And then what we do is say, okay, go tell me. Everybody goes and drops stuff off at Savers or at, all the different places, Vietnam Veterans of America. Everybody's cleaning their basement out, taking junk, and dropping it off. Those are what's called non-cash deductions. So there's a calculation that's put together that you got to kind of do fair market value on it, but you still get to get a credit for it. Even to the extent of trying to give away vehicles, boats. I think now there's 2 or 3 different places that'll take your old vehicle. They'll give you an appraisal for it, but you need a full form that has the VIN number on it and the whole shoot and match. I saw an advertisement back a while ago for now they'll take boats. So I guess if you got an old boat that you don't know what to do with, you can donate those guys. So just stuff like that, but you have to be able to itemize to get that. And that's I'll say 92% of the returns we do, they can't itemize. Just can't make that cut. So,
really quickly, married filing separate. What's that?
Yeah, so that's a way. So most of the time, this is somebody that's separated. They're not officially divorced at the end of the year, so they have to file married. But instead of saying, hey, I'm going to file married filing jointly, you do married filing separate. And that way you're not liable for the other partner's whatever they put on their return, because it's actually 2 separate returns. I mean, totally independent of one another. But the key to this is what we're now seeing is there's a couple of things. And this used to be some, outlier, scenario, but it's kind of coming to the mainstream today. One, it was basically to qualify for any of the pandemic benefits that were out there. So you'd get a little bit bigger, stimulus checks. But typically it's when you do married filing separate, you're not liable for the other partners, whatever they put on their return, that's not your baby. Okay. Yeah. So if you're separated but not yet divorced by December 31st of like this year, you'd have to do married filing separate. But others do it because it reduces their tax bills. Okay. So let's go back to that medical scenario and say one of the partners, one of the spouses has huge medical bills, and you're close but not close enough for the standard deduction. So you do married filing separate, and you let the one spouse take all those medical bills. Boom, now they can itemize on their side, and they get to go forward with it.
Oh, yeah.
And so it may help from a bigger tax, savings. The other one basically is now some of them do it because student loans. So if you're in the public service, which says, hey, you work for XYZ company for 10 years, we'll forgive all your student loans. That's another reason. And some business owners. So if you're a business owner and there's what's called this qualified business income deduction, which is one of Trump's tax laws out there, and it basically says, hey, 20% of your business income you don't pay tax on. Okay. But there's limits to it, and it's like $182,000 if you're single, and I think it's $350,000, $370,000, somewhere in that range if you were married filing jointly. So if your incomes are over that, you split it. You go married filing separate. It'll bring your income down, and then you get this 20% QBI deduction, possibly. But you're giving up some tax breaks on the flip side, which basically saying that you can't really do the American Opportunity Credit if you do that, either party. Lifetime learning credits for college would be taken away. The bulk of child and dependent care credit, which is daycare, so on and so forth, and the student loan interest deduction. And it could force some of your Social Security to be more of your Social Security to be taxable. And you typically can't do a Roth IRA when you do that. But remember, there's always what's called the backdoor Roth, which means if you do married filing separate and you save some tax money, you could do a backdoor Roth, which is, depending upon your age, you could either do $6,000 or $7,000 into a non-deductible IRA and literally convert it to a Roth the next day. So that's trying to take a whole bunch of stuff and compress it into a scenario, but that's married filing separately. Typically in the past it was, we're separated, we're working on a divorce. It may not make it by December 31st because December 31st is whatever you are, December 31st is how you have to file your tax return.
Yep.
So if you're still married but yet separated and you haven't finalized your divorce, you literally, on December 31st have to do married filing something, and you don't want to do joint because you don't know what your other partner did during the year. Do it married filing separate, and there's a bunch of perks that you could come along with that.
Jeff, thank you so much. We'll talk to you next week. 636-394-5524. Jeff Zufall, keep more of what's yours.
You've been listening to Keep What's Yours with Josh Gilbert and Jeff Zufall, Senior Tax Strategist and Wealth Manager at Capital Advisory Group. To learn more, call 636-394-5524 or visit CapitalAdvisoryGrp.com.